Hello, I'm William Murray, Chief of Media Relations at the IMF. This is the press conference on the latest World Economic Outlook update and the latest update of the Global Financial Stability Report. This press conference is live. I'd like to welcome people watching via our website and via our Media Briefing Center. On the Media Briefing Center, I'd recommend people start submitting their questions as soon as possible. We'll try to get to as many of them as we can during this briefing. I'm going to first introduce our participants, and then there'll be some brief opening remarks, and we'll take your questions. Olivier Blanchard, our Economic Counselor and Director of Research. Jaime Caruana, our Financial Counselor. Jan Brockmeijer, Deputy Director of the Monetary and Capital Markets Department. And Charles Collyns, immediately to my right, who is the Deputy Director of the Research Department. Olivier will open with remarks, and then Jaime will have some as well. Olivier.
Good. Thank you. Good morning. This is the second time I do this presentation, and I hope it doesn't become a habit, but I'm again the bearer of rather bad news. I suspect, however, that what I'm going to say will not come as a complete surprise, namely that in the last 3 months the global economy has taken a turn for the worse, and financial markets have remained under extreme stress, and global output and trade have sharply decreased. My purpose in my introductory remarks is really to make 2 points. The first one is to present the growth forecasts, which, as you'll see, have been revised substantially downwards since last time, namely since November. And more importantly, I think, to talk about the policies which are needed for restoring the global economy to health. So let me start with an assessment of the outlook. One way of summarizing our forecast is that we expect the global economy to come to a virtual standstill in 2009. There are important differences across countries. In the advanced economies, we basically forecast the sharpest contraction in the post-war period. To give you the basic numbers, we expect real activity to contract to about minus 1.5% for the US and 2% for the Euro zone and 2.5% for Japan. If you look at the rest of the world, the numbers are better, but indeed the emerging and the developing economies are going to do better than in previous downturns, but relative to their underlying growth rate, they are still going to do quite poorly. For example, we now forecast growth in China to be around 6.5%, and we forecast growth in India to be around 5%. Now, you can aggregate these numbers using weights for national production. When you do this, and you use what we call PPP weights, then you get global growth to basically be about 0.5% in 2009, and this is the lowest rate since World War II. An interesting aspect of the revisions, first the revisions are very large. If you go back to what we had announced in November, the downward revision for the world as a whole is 1.75 percentage points, which is very large. It's actually roughly of the same size for the advanced economies and for the rest of the world. But behind this similarity, there are actually substantial differences in the factors which are affecting the different parts of the world. So let me turn to the second point, which is why we have revised our forecast so much. Well, quite simply because the global financial crisis has taken an increasingly heavy toll operating through different channels across countries. And here it's important to distinguish between the advanced economies and the emerging and low-income countries. So let me start with the advanced countries. There, the impact and the bad news has come mostly through domestic channels, as the financial crisis has weakened consumer and business confidence, raised uncertainty, and destroyed wealth, leading to much lower consumption, much lower investment. And the crisis at the same time has made it much more difficult and costly for consumers and for firms to borrow, dragging down activity and trade. At the margin, however, what we've seen in the last 3 months is more the effect of collapsing confidence than the direct effect of a credit crunch, although the effect of a credit crunch is there and is likely to get worse rather than better in the near future. In emerging economies, the story is a bit different. The impact of the financial crisis has worked mostly through external channels. There are basically 3 of them. The first one, weaker external demand from the advanced countries, has led to a collapse in exports, and the numbers are dramatic. Second, the global credit crunch has reduced the availability and raised the cost of foreign borrowing to many, many emerging countries, and this is likely to actually get worse rather than better. And then for the commodity exporters, the decline in commodity prices has also affected their growth very directly, and here I think of the oil producers. In this case, different countries have suffered differently from each of these 3 shocks, but basically these 3 shocks have been relevant in general for that set of countries. Let me now turn to the second half of my presentation, which is the policies needed to resolve the crisis and get a lasting turnaround in global activity. And first, we need stronger policy on the financial front to basically restore financial sector health. Jaime Caruana will talk more about the diagnosis and the remedies that we think are needed to get the financial sector back to health. Let me emphasize here that restoring financial health is a necessary condition for a durable economic recovery. A strong fiscal impulse, to which I will come, can push the economy for a while, but basically cannot get back the economy to health. And so that part, the financial part, is extremely important. And here, what we see is that the building blocks of what needs to be done have been assembled to varying degrees in many countries, but a comprehensive framework for restoring financial health and dealing with bad assets remains to be built. And we think that the fact that this hasn't happened quite fast enough is one of the reasons why the financial crisis has lingered. We think that at this stage, more aggressive actions are needed through a unified approach involving liquidity provision, capital injections, and disposal of prime assets. And all these 3 components are essential. You cannot do with just 2 of them or 1 of them. This is to take care of the financial system and to get it back to health. In the short run, we have to face the fact that demand has collapsed, and therefore we need to take measures to support demand, and these are macroeconomic measures. And it's important because we need to break the toxic feedback loops between the financial sector and the real economy. And here let me talk about monetary policy and fiscal policy. So on monetary policy, many central banks have taken strong actions to cut policy rates and improve credit provision. There is still some room to lower interest rates, but the room is diminishing rapidly, and indeed in some countries is just gone. Moreover, deflation is now a risk. We have a report coming out today which discusses the issue in more detail, but we think that it is now a risk. In the current circumstances, it's clear that we have to basically think beyond standard monetary policy, and that central banks need to rely increasingly on unconventional measures to unlock key credit markets. And by key credit markets, I mean high spread, low liquidity markets. The evidence here is that intervention by central banks in those markets, in these liquid markets, can make a lot of difference, decrease the spreads, get the credit going, and can help a lot in the short run. On fiscal policy, many countries have announced and are already implementing sizable stimulus packages. The key here is to design packages which provide maximum boost to demand very soon. That tends to argue, in the current context, for measures focused on spending rather than taxes. Measures focused on taxes tend to have less effect in the short run than measures which increase spending. Now, at the same time, there is a challenge, which is that fiscal deficits are widening sharply because of a cyclical downturn, because of the impact on asset price declines on revenues, and because of the measures which are being taken both in terms of the fiscal packages and the financial packages. And so here, to prevent an adverse market reaction, it is essential that policymakers strengthen fiscal frameworks and commit to credible longer-term policies that reverse the deficit build-up as economies recover. That is really an essential part of what fiscal policy must be about at this point. A few more points on policy. The first is that there is no one-size-fits-all policy mix at this stage. Different countries have different shocks, have different constraints, and must adopt different mixes. Some countries have more fiscal and monetary space than others. In this respect, it's good that some emerging economies now have more space for policy easing than they had in the previous downturns and are making use of it. But in a number of emerging and developing countries, there is still a need, given that capital has gone out, is going out, and will not come back anytime soon, to basically adjust to this shock, and basically this has to be done through movements in the adjustment in the exchange rate. While the use of reserves and fund financing can help smooth this transition, these countries also need to rein in spending and improve external competitiveness. Now, let me turn to the forecast we make for 2010 based on the discussion that we just had. So assuming that these policies that I've described will be put in place, then we expect the recovery to start by the end of 2009. And this is based on a number of assumptions, either direct or derived from underlying assumptions about policy. The first one is financial conditions will slowly improve. Spreads will slowly decrease. The fiscal stimulus will come in play, and this will come later this year, given the usual delays. And the U.S. housing market will stabilize. Under these assumptions, we basically forecast growth for 2010. So the numbers for advanced economies are growth in 2010 of 1%, still far below normal growth, but at least positive growth. And for emerging and developing countries, we predict 5%. If this were to happen, then global growth would return to a number around 3%. Okay. Now, again, let me emphasize that these forecasts are based, depend very much on the timing and the pace of implementation of the policies that I've mentioned earlier. Now, let me end with risks with the forecast, and there are obviously plenty of risk to the forecast, and they are still probably mostly on the downside. The main risk is that the adverse feedback loop between the financial and the real sectors intensifies, especially if policy implementation at the fiscal margin or the financial margin falls short of what we hope will be done. The other risk is one that I've already mentioned, which is that the large fiscal deficits basically lead to worries in financial markets about sustainability of debt in the long run. And that's not only an issue for the long run, but when doubts of that kind arise, then long rates increase today and offset some of the effect of the fiscal stimulus and therefore make the policy less useful. So again, let me insist that the fiscal stimulus must be strong. We're not advocating for a small stimulus. It really has to be very large. But it has to be presented in the context of a coherent long-run fiscal strategy. Otherwise, it may backfire. Well, let me end going over risk with the possibility of upside risks. And I think there is indeed a chance that things turn out better than we forecast. The point is that it is true that many of the factors behind the crisis require a painful adjustment of the financial sector. Mistakes were made, and they need to basically be addressed, and that's going to be painful. But at the margin, the current crisis is largely a crisis of confidence. basically the decrease in spending on the part of firms and consumers is largely based on the loss of confidence and on what you could call a wait-and-see attitude, which is that in the present context of enormous uncertainty, it makes sense basically for firms and consumers to wait to see how things go before actually taking decisions. When they do this, it makes sense for them, but at the same time, demand drops, and that's what we've seen. So in that context, when confidence is a key factor and wait-and-see attitudes are so central, then you can think that if the right policy measures are implemented, confidence can actually build up faster, demand can start faster, and this starts a virtuous cycle in which basically the fact that the economy is doing better reassures consumers, leads them no longer to wait and see and start spending. So to conclude, with the right policies and a bit of luck, the recovery, I think, could come actually sooner and be stronger than we currently forecast.
Thanks, Olivier. Jaime?
Thanks. Good morning. You have a copy of our written update, so I can be brief and go to the main points about the situation and also about the measures. Despite the implementation of unprecedented policies and programs to stabilize the financial markets, we all know that systemic risk in the financial system remain elevated. Financial markets have continued to experience the pressures of deleveraging against the deepening of the economic downturn that Olivier has just described, and confidence among financial counterparties also remain strained. So let me go to the three main points. First, in terms of credit risk. The worsening in credit risk and credit quality affecting a broader range of markets and assets has raised our estimate of potential deterioration in the US-originated credit assets held by banks and by others, from the figure that you are familiar with, which is the 1.4 trillion in October in our latest GFSR, to 2.2 trillion now. Thanks to the massive public sector injections of capital that occurred in the fourth quarter, banks have managed to obtain sufficient capital to offset the existing write-downs. But going forward, looking forward, banks will need more capital as expected losses will continue to materialize. Estimates are quite difficult to construct, and it's not easy to move from the previous figure to the data of how much capital is needed. But we have tried to make a rough calculation, and for European and US banks, if we include not only the US exposures but other exposures too, our rough estimates indicate that at least $500 billion is necessary to prevent capital position from deteriorating further. We also emphasize in the note, in the update, that it's important to clean up banks' balance sheets to raise the level of confidence in the banking system. The second point is the funding gaps. With the various government guarantee programs, banks have begun to raise substantial amount of term funding, but markets are opening slowly. Central banks continue to supply generous amount of liquidity, but little of that is lent out to term, and much is being recycled in the overnight market or placed back to central banks. And this pattern reflects continuing worries about counterparties as well as uncertainty about future funding needs. The third point is about emerging markets. Emerging market countries and corporate borrowers remain vulnerable to continued deleveraging and credit retrenchment. Capital markets are risk-averse, so flows to emerging markets are likely to remain low. And at the same time, emerging market corporates face large rollover needs in some countries, as well as they are facing the additional challenges of falling revenues as the global economy slows. An important risk for emerging markets, especially in emerging Europe, is also whether parent banks can continue to support their subsidiaries in emerging markets in the face of these funding constraints that I have described. I think this rollover issue is important for emerging markets, but not only for emerging markets. In terms of policy, I would like to start emphasizing what Oliver said, the importance of restoring financial health as a kind of a necessary condition for a viable recovery of the economy. We think that more decisive action is needed now by policymakers and also by market participants, and also more, but also with greater emphasis on balance sheet cleansing. A comprehensive and coordinated approach needs to be framed in a strategy, around a strategy that incorporates several elements, in our view. The first is the three elements that we have always mentioned, the liquidity, the recapitalization, and the cleaning of balance sheets. But I would emphasize today the recapitalization and dealing with distressed assets. And this, in our view, requires a rigorous examination by supervisors of individual banks' balance sheets, of individual plans of the banks vis-à-vis the crisis, in order to determine which viable financial institutions may require public support in the form of public capital or asset restructuring. And the solution may involve, this approach may involve the use of different approaches, including the use of a publicly owned bad bank to remove these distressed assets. Again, the important thing is cleaning balance sheets in financial institutions. The second element, we think that short-run policies and actions need to take into consideration the long-run view of a viable financial system. It is important to recognize that the adjustment process will need to continue for some time, and that to get at the end a viable financial system. And this viable financial system will be less leveraged, and therefore it will probably be smaller in relation to the size of the economy. And the important thing is that we have to make this process orderly. We also emphasize that attaining higher capital ratios needs to be done in a gradual manner in order to avoid aggravating the adverse feedback loop to the real economy, in order to avoid more procyclical effects of the regulatory action. The third element is clarity and consistency of the rules. We think that to restore confidence, transparency and clarity are essential in both the private sector, but we are talking now more on the public sector. And this element of clarity, along with the other three elements that I am mentioning, should contain some of the risks of the measures that are being taken, such as distorting the credit allocation decisions or crowding out markets that do not receive a special treatment, or disfavoring more efficient financial institutions that do not require public support. And finally, it's important to emphasize the internal cooperation. Applying substantially different approaches or parameters in treating financial institutions and systems should be avoided in order to prevent unintended consequences that may arise from competitive distortions. International coordination is also needed to avoid excessive national bias, whereby domestic institutions are favoured or local credit provision is encouraged to the detriment of other countries. Let me conclude by saying that the commitment by country authorities that is demonstrated through the wide range policies and measures that have been taken is unprecedented and very welcome. It is not usual in these updates to talk about the measures for the long run, but I think it's important to emphasize that looking to the medium term, the initiatives that are already underway to improve the regulatory and supervisory framework will also be crucial to build a safe and resilient and innovative financial system. And I think they will also help to restore confidence in the short run. Thank you.
That's great. Thank you, Jaime. Thank you, Olivier. We're going to start taking questions. Try to work in as many from the room and then take some from the media center. Can you identify your name and affiliation when I call you? Thanks.
So for Mr. Caruana, you discussed the need to recapitalize the solvent banks and perhaps take over those that are not viable. But when we've had so much difficulty valuing the assets on banks' books, how can supervisors determine which are solvent? And is it going to require some sort of government intervention to force banks to write down the value of loans?
I mean, it is much more easier said than done, that's for sure. And we recognize the difficulties in doing this assessment. But I think this has been a clear message that comes from many crises. This crisis is more complex. This is much more difficult. We recognize that, especially in structured products. But at the end, this assessment needs to be done. The losses need to be recognized. And I think that it is necessary to do it on a bank-by-bank and with the support and the cooperation and perhaps the interaction between the bank and the supervisors. I think it can be done. It will not be perfect, and it's to be done because if the balance sheets are not clean, the confidence in the balance sheet of the banks is not restored. And this is what we think we are seeing. The figures that we have published and how the credit is deteriorating just because of the downturn of the economy indicates that this is a kind of moving thing. Unless the banks' balance sheets are clean, it will be always a continuous calculation. It will be always continuous uncertainty about that. So I recognize I'm not providing with the full solution. I think in any case that the past crises demonstrate that this is extremely important. And this is perhaps the piece where in the toolkit that perhaps has not been utilized that much. And in part is for your question. I mean, it is not easy, and we recognize that. Still, it needs to be done.
Thanks. Take the gentleman up in the right here, center.
Hi, I'm Hugues Honoré from AFP. My question is about China. You are telling us that China will remain in 2009 a world champion for economic growth. But when you listen to the facts that are reported from China, you hear that capital expenditure has virtually stopped in the country, that many manufacturers are sharply reducing their production, and that the financial sector is in really bad shape. So where does this growth come from?
Shall I respond to that question? I think the data in China need to be looked at very carefully. You're certainly right that if you look at the supply side data, the data for industrial production and exports, the data coming in for the fourth quarter have been very weak, and that was reflected in a relatively weak GDP number for the fourth quarter. However, we see demand side indicators remaining relatively strong. It's certainly slowing, but not collapsing. And it seems that in part what happened in the fourth quarter was a rundown of inventories by the industrial sector in the face of slowing global demand and some build-up earlier in the year. Going into 2009, we see quite strong support coming from policies, both on the fiscal front and also monetary policy. In combination with quite resilient demand, we do see China being able to weather this global storm somewhat better than others. But even China's growth will be very much below what it was 2 years ago. I mean, growth was around 13%. So we're having growth coming down by half in 2 years. So that's a pretty dramatic deceleration. So China is being impacted as much as other economies around the world. But given its stronger base and substantial room for policy response, we do still have China growing at a fairly robust pace.
Thanks, Charles. Take a question up here in the rear, and then we'll turn to the media center.
It's Manelis Duwasa from the South African Broadcasting Corporation. I just want to ask something from your update, some more clarification. You say that developing countries in Africa and elsewhere are also better prepared this time to face policy challenges because of improved macroeconomic policy implementation. But the continent is in a weaker position than most other regions because of its poverty levels and reliance on commodity exports. I just want to know, is it perhaps because most of these countries in Africa, these emerging markets in Africa, part of the reason is that they can't afford stimulus, for instance, or there are other elements related to this, that their weaker position. If you can just expand on this. And secondly, when Mr. Olivier Blanchard started to say the economy will come to a standstill in 2009, and I was just wondering, couple this with the high food prices, does this mean that we're looking even at high poverty levels that we have right now? Thank you.
Yeah, maybe just respond to that one as well. Indeed, as you say, we do see Africa as being vulnerable to this global crisis, in part because although fiscal frameworks have been strengthened in recent years, there is less room for countries in Africa to take the quite bold stimulus measures that are being introduced in advanced economies and a number of emerging economies, given the less developed character of capital markets, given the less strong fiscal frameworks that would allow tax revenues to be increased in the future. We think African countries do need to remain fairly cautious rather than introduce large fiscal stimulus packages. Also, I think the impact on poverty is increased by the fact that these countries do not have the capacity for the large-scale and effective income support measures that a number of emerging economies, for example, in Latin America and Asia, have introduced. So I think low-income people in African countries are at particular risk, which is why we are concerned that both policies be prudent, but also that aid flows be maintained to Africa over the years ahead.
I want to follow up on the other bits. Let me turn to the Media Briefing Center here. This is a question from Francisco Vergara of Alternate Economics. It's about the differentials between the Eurozone and the U.S. Why will 2009 GDP contraction in the Eurozone be greater than that in the United States?
This one I'll take. There are two elements to take into account here. Is that the underlying growth of the United States, the underlying growth rate of the United States is higher than that of the Euro area and that of Japan. So that if you start from a smaller base and you go down by the same amount, then the numbers look worse. In addition, we think that fiscal and monetary policy have been a bit more aggressive in the US than in the Euro and in Japan, and that explains also some of the difference.
Okay, thank you, Olivier. Gentleman in the right here.
Cesar Munoz with EFE. I have two questions, if I may. One for Mr. Caruana. You have mentioned that so banks will need $500 billion to keep on going as they are. And I guess you don't include in that amount what will be needed to dispose of these bad assets. And I wonder if you had an idea how much that will cost. As you know, there is also talk of nationalization as a possibility that will provide taxpayers with the possibility to recoup more of the money than just buying the bad assets. And my second question is on Latin America. I mean, there has been a drastic decrease in the forecast there. And in the past, you have said that the main channel of contagion was trade. And I was wondering if the financial sector is now another channel, especially in light of what Mr. Blanchard said regarding parent bank companies and taking capital out of emerging markets. Thank you.
Thanks. We have, on this occasion, made an update on the capital that we think, and it is a very rough figure. From that amount, you can make calculations on how much would be the amount that would be needed for taking out assets, but we have not done these calculations in this update. So in the next GFSR, we will provide with a more elaborate, full assessment of the whole thing. But there could be some kind of equivalence. In any case, yes, I think it will be both the capital and the asset cleaning are part of the solution of the present situation of the banks. There was another discussion, and you mentioned to what extent is nationalization. I would like to say that what we have said when we talk about supervisors taking a view, full assessment of the situation of the bank, it may be that in some cases some full-blown intervention is needed on the part of the authorities. In this case, the asset valuation perhaps has less importance in the sense that the authorities are in both sides of the situation, and it may be necessary. I think we are calling for this kind of assessment to be done. We are not prejudging how much or how many times that would be necessary. In terms of Latin America, I think the channel, the financial channel, is another important channel in the transmission of this crisis. And I was mentioning that the drop in flows to emerging markets has been important. The risk aversion on capital markets is explaining part of it, but there is a rollover needs that is coming in part mainly on the corporates that needs to be taken into account. So yes, I think this is an important element that needs to be followed. And in the policy measures, we were talking about coordination. We think that to the extent that the measures will be coordinated, at least some of the unintended consequences that some of these measures may have in terms of crowding out some of these flows could be diminished or could be mitigated.
Okay, thanks. You want to? Yeah, excuse me.
Just add on Latin America. And Olivier mentioned three channels by which emerging economies were being affected: financial, trade, and lower commodity prices. And Latin America is being hit quite hard by all three of those channels, certainly, as Jaime says, the financial channel, but also has been a dramatic drop in exports and a dramatic drop in commodities exported by Latin America that is having a very negative impact on activity in the region. We've already seen that in the data for the fourth quarter, and we expect weakness to continue. But I would emphasize that Latin America has much more policy resilience than in the past, room to provide fiscal support to the economies, room to let exchange rates move more flexibly, room to use international reserves to address liquidity problems. So although we expect a sharply weaker performance in terms of growth, we don't expect a return to the crises that we saw in Latin America in previous downturns.
Okay, thanks for that. I'm going to go to this gentleman here on the left, and then I'll...
Tony Walker from the Financial Review of Australia. I have two questions, one parochial perhaps and one not so parochial. The first question has to do with Australian growth. Last week the Australian newspaper reported, based on an interview with one of your colleagues, that Australian growth would go to zero this year. I don't see specific reference in this chart to that projection. Do you have estimates for Australian growth in 2009 and 2010 specifically? And the second question has to do with Mr. Obama's stimulus package. Have you formed a view about the package, and does it fit into the pattern of remedies that you're recommending?
On Australia, you have to answer.
Well, we're not at this point in a position to provide GDP projections for countries other than those included in Table 1.1. We'll provide the full detail when it comes to our spring WEO in April, but not at this point.
And on the fiscal stimulus, yes. I don't know if you were asking me about the Australian one, which I know nothing about, or the general, in general.
The Obama one.
Oh, the Obama one. Well, I'm going to stay away from specifics, but if you read the fiscal paper that we produced a few weeks back, in which we tried to think about what an optimal package should have, we basically insisted on some of the elements I've talked about, which has to be strong, but one has to see how it will go away when things return to normal. And in terms of composition, we emphasize the fact that at this stage, the purpose of a package like this one, it's not always the case, but here it is to basically have the maximum impact on demand. And therefore, that in the current context, it probably is better if you have spending projects more or less ready already soon to actually do it, because at least in the first round, you get an effect of one, and then after this you may get more. Where if you give it to consumers who are, say, in a frozen state of mind, say a wait-and-see frozen state of mind, they may well save most of it, in which case it will not be tremendously useful. So our recommendations were that there should be as much as possible on spending. I think the limits there are that you don't want to waste it on totally useless projects, but you want to go as far as you can. And then if you're going to do tax cuts, you should try to aim them at the people who are most likely to spend it. So the people who are credit constrained, the people who have problems in the housing market, the unemployed. This would be, from an economic point of view, I think the ideal package. Political realities imply that you actually need buy-in, and so it may be that some of these packages that we're seeing will have a larger room for general tax cuts. These may well be needed politically, and they'll do good things for the people who receive them, but in terms of multipliers, they are going to be less useful than some of the other measures.
Thanks, Olivier. Gentleman in the rear.
Barry Wood, Voice of America. Mm-hmm. Mr. Caruana, I'm not sure I understand the 2.2 trillion. When you say here that potential deterioration in U.S. originated credit assets, that presumably means just bad loans here in the United States. If so, what percentage of those are in real estate? And what about the losses in Europe on real estate? And also, what's the breakdown in terms of what percentage of United States-based banks hold those bad loans and European?
Okay. We think that this figure that we are providing, that we started 1 year ago to provide, is a kind of a good indicator of how the credit deterioration is moving. And what we are putting together there is just the assets that are originated in United States. We're not providing with the whole disclosure, this split of the different items in this update. We will provide more granularity on all these calculations in the GFSR. But still, I think the important message there is first that the amount of deterioration is significant. And I would like to say that also that the uncertainty about the figures in terms of sensitivity to assumptions is quite significant. The figure that we are providing with is a figure where we try to be consistent with the macro scenario that the IMF is foreseeing for the closer horizon. And basically, if you want to disclose grossly what are banks and non-banks, we can take approximately the same ratios that were used in the previous GFSR, where you have a more complete table. You will get for banks a figure that is around 1.3 out of these 2.2. But again, I would caution not to try to move from there to what is the capital. We have done this rough estimate, but it implies many other assumptions in terms of what would be the revenues, what would be the capitalization that has already occurred. It is not a straightforward calculation. We are not providing. This is not the purpose of the update. There will be more detail in the future. But the message is significant. We are talking about important figures, and we are talking about deterioration that requires that looking forward, more capital will be needed for the banks. But I would like to emphasize that these are really gross estimates and not accurate estimates.
Can I maybe just add one small point to your question on the extent to which mortgages were the cause of the losses? Of the 2.2, you can say that more than half were related to either mortgage securities or other direct mortgages outstanding at the bank. So it's more than half of the total amount.
Thanks, John, for that clarification. I'm going to turn to the Media Briefing Center. This is a question that applies to both Olivier and Jaime, I believe. It's from Heather Scott of Market News International. She's looking for a little bit more insight into comprehensive policy actions. What is missing in order to achieve what you call a comprehensive policy approach to the financial crisis? What specifically do the advanced economies in particular need to implement?
Well, I thought that was basically what we tried to address in the update, in the 4 points that I mentioned in my presentation. Basically, what we are saying is, yes, the so-called three-pronged approach needs to be continued, but perhaps more emphasis needs to be done on, of course, continued capitalization, but dealing with distressed assets. So we think that this is one of the key elements there. And again, a rigorous assessment on a bank-by-bank basis is needed to be able to move this forward. The other element that I mentioned is to be consistent with the long run, and the long run means that there will be more deleveraging, and we have to be consistent with that. We need to understand that there will be more deleverage, that it will be difficult for, and not soon, that credit could start to grow because the banking system is deleveraging, and this is the basis for a viable financial system in the future. We think that consistency of the rules and clarity of the rules is essential. We need to know what are the rules, and we need to have a level playing field that do not disfavor some efficient financial institutions that perhaps do not need the public support. And we need international cooperation, and the international cooperation is, can be defended from many points of view, but it's a very, very important element, because if not, we risk crowding out some of the flows that are needed at this very moment to support the global economy, especially to emerging markets. And this avoiding this national bias is part of it. So we think that these 4 elements constitute a comprehensive package. So more is needed, but these more should be framed into these perhaps 4 elements that provide some cohesion and international coherence to these kind of packages. I mean, again, it's much more easy to say it than to do it. But at least this analysis needs to be done, and I think authorities need to be conscious that these elements have to be in the package.
Olivier, anything to elaborate on in terms of comprehensive policy approaches?
No, I obviously agree with Jaime. I think the dimension in which there has been the least progress is in putting a price on the troubled assets. And I would say nearly no matter what price you put, will be an improvement in terms of reducing the uncertainty associated with balance sheets. And this is really, I think, of 4 margins that Jaime has mentioned, the one where I think most urgent progress is needed.
Great, thank you. Gentleman left, right there. There you go. And I'll get the gentleman next to you after you're done. Yeah.
Bob Samuelson, Newsweek. This is for Olivier Blanchard. This is the second time you've revised the normal WEO for the fall. 2-part question. One is, until late summer or early fall, the American and the world economy seem to be stumbling along, not doing great, but not doing terribly. Then something happened. What happened? Was it just Lehman Brothers, or was something else? The economy basically, both the world and the American economy, seem to have fallen off a cliff. Second part of the question is, your forecast did not anticipate the severity and nature of this crisis. I think it's fair to say that that is reflective of most economists, with a few notable exceptions. What happened? How come?
Okay. Yeah, what happened between summer of last year and now? I think there are 2 events which I think none of us had fully anticipated, or if they had not anticipated the implications of. The first one is what we refer to as the Lehman event. And whether it was that particular event and otherwise things would have been fine, or something like this would have happened around that time, a bit before, a bit after, we can discuss. But at least I think it put on the scene the notion of counterparty risk in a way which just had not been there before, leading to a dramatic change in behavior of financial actors and all the consequences. I think this we missed. Again, was it Lehman or was it coming anyway and just took the form of Lehman? We can discuss. The other surprise, at least to me, but I think to most of us, is the total drop in confidence that basically seemed to take hold of the world as a whole within a few weeks, in which the indices of consumer and business confidence just collapsed around the world. And it seemed to be largely based on not actual facts, but just the perception that something big was there. It was hard to understand, and this was very scary. And this in turn led to the demand fall, which in turn led to the worst position of the financial sector. I think these are the two events that we did not understand ex ante, happened and forced us to revise. Now, how guilty is the fund? Well, I mean, I think very few of us predicted these two events. I think we can plead slightly less guilty, maybe, than others, in the sense that first our forecasts have tended to be short of the actual curve, but ahead of the other forecasts since the beginning of the crisis. We've been more pessimistic, not pessimistic enough, but we've been more pessimistic. But more importantly, I think, given forecasting is such a complex activity, if you think about the messages, the policy messages that we have sent going back basically to the early fall, I think we've been very, very explicit early on, and probably earlier on than most, on the need for what Jaime calls a comprehensive solution to the financial system. But it was just not going to be just recapitalization or just liquidity provision or just asset purchases, but that any coherent plan had to have the three components in. I think we repeated that message. That message, I think, was not fully taken into account in some countries. Then later, when we saw the drop in confidence, I think that one of the advantages of being the IMF, as opposed to being a national organization, is that we get much more data. We see things coming from further afar. I think we saw the tsunami wave earlier than others, and we went out very aggressively pushing a fiscal stimulus package, saying that this was a really essential part of a policy package. And I think there we did a good job, and I think we had some effect on the perceptions by government. So, sure, we did not anticipate everything which happened. That's why we revised forecast down twice. But again, I think that we've reacted quite well, both in terms of taking this into account and, much more importantly, giving, I think, policy advice which, as of today, looks like the right one.
Thanks, Olivier. I'm going to take a question from here, a few more in the room, and then we'll wrap up. This gentleman here.
From China's Citing magazine. So for emerging markets, your forecast on inflation in 2010 is even lower than 2009. What's the reason behind that, and what do you imply from that? My second question is, back in China now, many economists, they are talking about deflation, and that's because our CPI dropping speed is very fast. How big do you think the chance is there? And the last one is, Japan has injected some capital into the IMF. When you talk about international cooperation, do you still expect China to inject capital to IMF? Thank you.
Yeah, the third question is kind of off topic, so we'll stick with the first two. How's that? Thanks. Yeah.
Let me respond to those questions. First on inflation, I think there's a substantive answer and a technical answer. The technical answer is that the numbers we provide are year-over-year rates of inflation rather than quarter over quarter. So it slows from 5.8 to 5 on a year-over-year basis. the slowdown is less pronounced looking at a four-quarter during the year. So on that basis, it's 4.7 and 4 to 4.2. So around half a percentage point slowdown. And substantively, the reason for that is that we expect that the global economy will be running substantially below capacity in 2010 as well as in 2009, putting downward pressure on inflation during that period. Although there's a modest recovery in activity, it would still leave the global economy operating well below capacity levels, so that the downward pressure on inflation will continue. On inflation in China and deflationary risks, as we've discussed before, we see activity growth in China being quite well maintained. We don't see a collapse in activity. We also see substantial policy room in China, both fiscal but also monetary policy space. There is considerable room to lower interest rates further in China were deflationary risks to intensify there. So we are highlighting greater concern with deflation on a global level and a number of particular areas, and I draw your attention to a note we're going to publish today on deflation. But China would not be the center of our deflationary concerns at this point.
Okay, thanks, Charles. The lady there, and then I'll come to you. How's that? And then we'll start wrapping this up.
Thank you. Christina Bergmann, Deutsche Welle, German International Radio. I have a question about Russia. Looking at the projections from November 2008 and now in January, the biggest difference seems to be in number about Russia. Could you please explain why this is so?
Russia is another of these emerging economies that has been hit by multiple shocks. Quite obviously, Russia is affected by the collapse in oil prices and the decline in oil revenues. But Russia has also been badly hit by financial turbulence. Prior to the intensification of the crisis, Russia had received very heavy capital inflows, particularly into the banking sector, that led to a very rapid expansion of domestic credit. Particularly since September, those flows have reversed, and there's been quite heavy, I would say almost extreme stress in the Russian financial system. That has had a very substantial economic impact. So our downgrade in the Russian forecast represents the combination of those two factors, to some extent cushioned by policy responses by the Russian authorities to provide liquidity to the banking system, to provide fiscal stimulus, and to allow the ruble to depreciate. But nevertheless, even with that policy response, we are seeing a much weaker outturn for Russia in the year ahead.
Thanks, Charles. Lady there.
Nicoletta Nencioli, ANSA News Agency. Couple of questions. Going back to real economy and the crisis of the automakers who is spreading, do you believe that the different governments are going in the right direction, planning bailout and aids for the automakers? Connecting to my second question, only in Italy there is a risk for 60,000 workplaces if there are no intervention, and the forecast for our GDP are pretty bad for the next couple of years. What do you think should be, in general, the measures taken to get out of this crisis, not related only to the automaker industry?
Good. I'll take the first half of the question on automakers, and again make it more general than just specific companies. I think the two principles here should be that this can be a disguised way of giving an advantage to national companies. And I think there is a risk that if governments start protecting automakers or helping automakers, this is in effect disguised protectionism. Does this mean that there is no case for helping automakers or any other firm? I think the answer is no. We basically know that credit markets are dysfunctional. And therefore, we think that to the extent that we can make them more functional, the way, for example, the Fed is doing it in the commercial paper market, then that's desirable. So if a particular company needs credit, should get credit on the normal conditions, normal macroeconomic conditions, and cannot get it, then there is surely a case for governments to help get credit to that company. But that should be very much across the board, rather than a specific set of subsidies to a specific set of companies.
On Italy, certainly our outlook is quite grim. The GDP is already contracting this year, or last year, 2008, by 0.5%. We're expecting further contraction this year and even a modest contraction in 2010. And I think the key point is that Italy came into this crisis in a very weak position. Its economy was already contracting in the middle of last year. And although it's not been at the center of the financial crisis, clearly it has been affected by the global drop in demand for goods hitting Italy's export sector. Also, Italy has limited space to respond with in terms of fiscal stimulus. It has allowed the automatic stabilizer to work. It's provided some measures of fiscal stimulus, but it just don't have the room, given the very high levels of public debt, to take the large responses that have been seen in some other countries. We have been flagging concerns with Italy's economic performance for some time, and I think in the end, even after the present storm is dealt with, there is a need for more fundamental structural reforms in Italy to improve competitiveness, to improve productivity growth. And those, I think, will be discussed in more detail when we release our Article 4 report for Italy, which is going to be in early next month. So it'll provide an opportunity to get into more detail on some of those issues.
Thank
okay,
you. Can I have a clarification only? What Mr. Blanchard said about the automakers, just to make sure I understood correctly, you said that the different industry should get credit from normal condition before, in case the intervention of the government. Is this correct? Otherwise, it would be a disguised help and nationalization.
Yeah, we should make credit more easily available whenever the credit market in which the firms are operating is dysfunctional. And that should be the principle, not whether we're helping industry X or industry Y.
Okay, we have a number of questions regarding China's foreign exchange policy from the Media Briefing Center. I'm going to take one of those questions and then conclude this with one question here from the audience. From the Media Briefing Center, is this the right time for China to reconsider its currency policy?
It is probably not the right time to focus on the Chinese exchange rate, given that it is not a central element of the world crisis. There are many other things that we should be thinking about. It is an item on the list, but it should not be at the top of the list. That's the first point. The second is I don't think that we should obsess about an exchange rate. We should basically, the right question is whether China is following the right macroeconomic policy, both for its own interest and in the interest of its trade partners in the rest of the world. I think the answer there is a complex one. I think that China has basically adopted the policy of export-led growth for a very long time. It has been amazingly successful in terms of growth, in terms of changing China, and that was very much for the best. At some point, it makes sense for a country which has relied on export-led growth to actually shift a bit from external demand to internal demand and satisfy some of its internal needs. And there has been a debate, I think, both in China and at the Fund, as to when this shift away from external demand, export growth, to internal demand should take place and at what rate. The question is still there. We think at the Fund that it would be in the interest of China, both for its own sake and probably for its trading partners, to actually slowly shift away from exports towards internal demand. If there was no crisis, this would definitely require an appreciation of the RMB. In the context of this crisis, it may happen without this, to the extent that export growth in China is falling like a stone. there will be very strong incentives for the Chinese government to prop up internal demand and therefore do some of the adjustment. But in a longer context, it seems to me that, yes, it's probably a good thing for China and for the world to have an appreciation of the RMB. But again, I do not think that this is a central element of the crisis. It's something we should be thinking about, but not obsessing about at this point.
Thanks, Olivier. Last question of this briefing, the gentleman up there.
Yes, my question...
Can you identify yourself? Sorry.
Yes, sure. Piotr Cheremushkin, Interfax News Agency, Russia. Could you please be more specific in the evaluation of the current situation in Ukraine?
I think that's getting into a level of detail for this briefing that we can't get into at this time. That's something that posed at the...
Maybe in general terms.
Well, Ukraine, like Australia, is one of the countries that we're not covering in this briefing. But.
The Spring World Economic Outlook gets into the broad brush of individual country items. So I'm sorry to have to wrap up this briefing on that note, but I appreciate everyone joining us today, both our viewers on the Internet and the Media Briefing Center, Olivier Blanchard, Jaime Caruana, Jan Brockmeijer, and Charles Collyns. Thank you all. Any follow-ups, media@imf.org. Email to media@imf.org. Thank you.